As expected, the Federal Reserve has decided to leave interest rates alone despite ongoing pressure from President Trump. Bradley Blackburn tells us why tariffs played a role in the decision.
Interest rates for loans on homes and cars will remain high for a while because the Federal Reserve is keeping a benchmark rate unchanged to keep inflation in check.
Inflation has been running somewhat above our 2% longer run objective.
Fed Chair Jerome Powell and 8 other board members voted to leave rates the same. But 2 members, Michelle Bowman and Christopher Waller, wanted a rate cut. The first time in 30 years 2 policymakers have dissented. President Trump also wants cuts.
We should be lowering the rates.
He's been keeping up pressure on Powell, including a visit last week to see the renovation project at Federal Reserve headquarters.
People are pretty much unable to buy housing because the interest rates are too high.
The president points out that new numbers show GDP, a measure of the economy, is better than expected, so he argues rate cuts should follow. But the Fed wants to see if the president's tariffs have a major impact on prices.
Increased tariffs are pushing up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen.
Chairman Powell says any future cuts will depend on the economy.
If we start to see prices tick up and inflation on the move, the Fed is not going to act this year. If the inflation looks like it's sort of a temporary in nature, then the Fed is going to look more at the economy and see if growth is slowing down.
It seems like the Fed is sticking with a wait-and-see approach, and it looks like U.S. consumers will have to do the same. Bradley Blackburn, CBS News, Summit, New Jersey.